Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. We are on episode 13, if you can believe it here. Ryan Nelson, how are you today?
Lucky number 13. Doing well. How about yourself?
I am doing just great. Thank you. My name is Aaron. As I mentioned, I'm joined by the founder of Alchemy Wealth Management here. Find his popular book, Your Fiscal Physical, 7 Keys to Becoming Financially Fit on Amazon. Once again, thanks so much for joining me here, Ryan. 13 episodes in, it feels like it's a blink of an eye. I know I've learned quite a bit. I don't know if you've learned anything, but
yeah, it's been fun.
Yeah, definitely. I feel like we've had some good stuff, and we're kind of just. I've done a podcast before, and I've talked about like, oh, you have to have a certain number of episodes or hours to really kind of find that flow. Sure. And I feel like we're approaching like to where it's just going to get better from here too. So appreciate all the listeners who have tuned in so far, and I think it's only going to get better from here.
Absolutely.
Awesome. Well, let's dive into this week's topic here. One I'm very excited to talk about, as I say with every topic, but we're going to talk about mutual funds today here. And I've mentioned before on this podcast, sometimes you're at a party or you're hanging out with a group of friends and somebody's talking, finances, or they mention, oh yeah, I'm pretty invested in mutual funds, or this mutual fund's doing awesome, whatever. And I just kind of nod and smile along. I'm like, sure, I'm sure Ryan has me in some good stuff here too. So, but I'm hoping you can give the listeners a little bit of a high level view and kind of break down what actually is a mutual fund.
Right. Yeah, so exactly right. I and it's funny you say that because I hear people all the time using the term mutual fund sort of incorrectly. And they actually own some different investment, but they're referring to that investment that is not a mutual fund as a mutual fund. Or even I hear people talk about, sometimes they'll have a Roth IRA and they call the Roth IRA a mutual fund, even though that's not necessarily the case. So yeah, there's a lot of, I think, misunderstanding and misinformation out there, just in general, but certainly around mutual funds as well. And so the first mutual fund, I think, started back in 1924. So that's
long time.
Yeah, 100 years,
baby.
Yeah, 100-year anniversary, right? So yeah, that's a long time. And what's mind-blowing to me, it's hard for me to even conceptualize that. Like, the world was a different place 100 years ago. I mean, again, it's mind-blowing to me. Personal computers were not a thing.
No.
So thinking about buying and selling these like mutual funds, like the process that would take to actually make this happen, would have just been drastically different than what it is today, right? And I think some of that like is still ingrained in what a mutual fund is today. The trading is all done electronically and stuff now, but if we think about it, the core foundation of how these things were created like took place well before personal computers were a thing, right? So we'll circle back and talk a little bit more about what that means. But it's kind of some high level stuff. So I'll talk about the logistics of a mutual fund here in a second, but I'll kind of hit some some just like highlight stats of them. So typically they're actively managed. We can dive a little deeper into that in a second. But most often, most mutual funds are actively managed. Also, there is an expense. There's a cost to own a mutual fund. We'd typically refer to this as an expense ratio. So it's a percentage of the fund that you own that you pay in the way of a fee. That expense ratio, it's really hard to find what the average is, but from best I could gather, it's probably somewhere between 0.5%, so 0.5%, to 1%. Somewhere between 0.5% and a 1%. Again, that'd be the expense ratio for these mutual funds. And then, let's dive into sort of the logistics of how these things work. So if you and I wanted to go out and just buy some investments, and you said, Ryan, I want to go buy some investments, but I want to be diversified. And, we should probably put a pin in that and do a future episode on what exactly diversification is and the value of it. But if you came to me and you were like, Ryan, I want to buy some Apple computer stock right now, that's selling at roughly $180. I want to buy some Boeing company, that's selling around $200. Maybe I want to buy some Chevron that's selling at $150. I think you had mentioned that on a previous episode. You want to maybe buy Meta. That would be almost $450, almost $500 per share, right? So Microsoft, that's over $400. Netflix, almost $600. Nike, over $100. So if you came to me and you said, Ryan, I want to buy this like diversified portfolio, so I want to own a bunch of different investments. Here is a reasonable amount of money to do it. We could go out and buy you all these individual stocks, right? But especially back when these first started, there'd be large commission charges with buying all these individual stocks. And then today we saw what the cost of some of these are. Like you wouldn't, you can eat up an investment balance pretty quick with just a couple of these stocks, right? And so when these started, this was a way to pool money together. So if you said, I want a diversified portfolio, I said, I wanted a diversified portfolio, and maybe we get 8 friends and they all want diversified portfolios. So we could, in theory, combine all 10 of us would combine our assets together, and now our money is pooled, and now we could go buy a diversified portfolio with that pooled money. And then basically we'd all be sharing, if we all bought in equally, we'd all own 1/10 of this pooled fund, right? And we'd just share everything equally. So we'd share the expenses equally. Instead of us each paying our own individual commissions, we can kind of get some discounts here if we all pool our money. So we'd split all the costs, we'd split all the gains, we'd split all the losses, we'd split all the tax implications. We'd just pool all of our money and kind of split everything equally. That's like the essence of a mutual fund. And so what would typically happen is there'd be a mutual fund manager who would come along and say, hey, I'm really good at managing money, right?
Sure.
And then they'd go talk to all their friends and say, hey, let's pool, all of our money together, and I'm going to manage this. So my job is going to be to manage this mutual fund. And so they'll buy stocks, sell stocks. So that's what I said earlier when I said mutual funds are actively managed. There's a mutual fund manager, most typically, that are buying different stocks and selling different stocks. So if you go buy mutual fund there's somebody, you can just own mutual fund A. The underlying stocks are constantly changing in mutual fund A. The mutual fund manager is the one that's buying and selling those stocks, right? And so there are expenses when you're paying mutual fund manager some salary effectively, right? And there might be some transactional costs and stuff. And that's all just being split and divided up amongst all the people in this pool, right? And so typically in a common day mutual fund, you're not splitting that with 10 people, you're splitting that with thousands
sure,
right?
Yeah,
of people. But high level, that is what a mutual fund is. It's this pooled source of assets gathering together, being invested, and you're sort of splitting all the costs, tax implications, all of that stuff.
That is really well broken down. And you made a good point about them. It started in like the 1920s.
Yeah.
Like the foresight on something like that to be like, oh yeah, let's you know what? Like it's costing me X amount of money to do this. It's costing you X amount of money to do this. Let's just all get together and do it together. And this guy's really good at this guy, Alchemy Wealth Management. This guy knows what he's doing. Like, let's let him do all of our stuff here for us. And then we all reap the rewards. But at the same time, we all kind of, I guess, share the what's the opposite of benefit?
The rewards.
What's the opposite of
the
rewards?
The cost.
The negatives, if you will. Everybody kind of like equally shares those at the same time.
The risk and rewards.
Yeah, the risk and rewards. Absolutely, you kind of reap both equally. So with that, and you kind of it's different than buying and selling stocks individually, obviously, because you're in like that, and so you could just be like, hey, I want this mutual fund, and then it just kind of is.
Right. So just to clarify, Alchemy Wealth Management is not a mutual fund manager.
Oh, right. Sorry.
No, you're good.
Yeah.
But so basically what it would be, you would find a fund that aligns with what you're trying to accomplish. And then once you put your money into that fund, you sort of have no say in the fund anymore, right? The mutual fund manager is the one that's picking the investment. So maybe you could go find all sorts of funds that do all kinds of different things, but maybe you want exposure to the airline industry. You could go find some airline mutual fund out there, and then you buy that mutual fund. The mutual fund manager is going to be buying and selling these airline industry related stocks. So now you have exposure to the airline industry. Gotcha. The mutual fund manager is the one deciding which stocks or even bonds get in and which stocks and bonds get sold. And then, and again, you could buy something, a mutual fund that just kind of tracks the S&P 500, or you could buy a mutual fund that tracks, the U.S. bond market, or, you could find almost anything you'd probably want to find, there's probably a mutual fund out there because probably other people want that same exposure. And so there's probably a fund you could find out there that does that.
Yeah, and it's really, I'm bubbling with questions right now because now I kind of understand, like I have a 401k at work and it shows like, hey, this is a 2050 specific fund is what it, and so it's like my goal is cool. I want to be retired at this time. And so it's like working towards that specific goal. I'm guessing that's
right. Yeah.
Is that right?
Yeah. So we typically refer to that as a target date fund.
Yes.
That could be a mutual fund. It also might be an exchange traded fund that we can talk about in a later episode. But at the end of the day, that is a fund. So your money, it's likely that your money could, if it is a mutual fund, your money would be combined with other people's money that are all trying to retire by year, say 2050.
Sure.
And then there's some mutual fund manager kind of managing those assets sort of in line with that retirement goal of 2050.
Awesome. No, that's great. It's kind of like the light bulb's going off a little bit here. So that's what I like to hear. But why would somebody, I guess, what are the pros of a mutual fund, like versus like, because we've had people on, or we've had questions that come in like, hey, I'm managing my own finances and I'm buying stock myself. Why would I need a mutual fund? I guess.
So the mutual fund, I alluded to it at the very beginning. It's a way to be diversified, right? So you could buy this one fund. In this one, like you said, maybe there's a 2050 retirement fund out there. You could buy one fund. That fund will own both stocks and bonds.
Okay, cool.
And it's going to own multiple stocks, multiple bonds. So you could be well diversified with one holding, right? So if you're trying to manage your own finances, it might be overwhelming to try to go buy, like, how many stocks do I need to buy? How many bonds do I need to buy? Which stocks, which bonds? That could be very, very overwhelming. If you found a mutual fund that aligned with your goals, maybe that's much easier. Like it's less overwhelming, right?
Sure.
So that ability to diversify is a big positive. Another potential positive, this would have mixed sort of reviews, whether or not it's a positive or a negative. But if this aligns with your values, it is actively managed. So there is that mutual fund manager who's actively buying and selling. And this is not true of all mutual funds, but in general is true. Most mutual funds are actively managed and do have a mutual fund manager. And so some people see that as a pro, where they say, awesome, I want somebody to be buying these different stocks and selling these different stocks. And if that aligns with your values, then having that active management is a huge plus for you, right? And what is also nice is it's passive for you, the consumer, right? So you could just buy this 2050 retirement fund, sit back, the mutual fund manager doing the work. You don't actively personally have to be engaged. They would be buying and selling kind of on your behalf throughout that process, right? So again, that would be a potential positive for you, the consumer.
Sure.
It kind of allows you to be more passive because there is an active component behind the scenes.
Right. And I mean, everything that you've kind of just shed light on here sounds like, for me personally, once again, finance is personal. That sounds great to be able to. What are some of the cons? What would you say are some of the drawbacks, I guess, to why somebody maybe wouldn't want to be in a mutual fund?
Yeah. So just like I said, one of the pros was it being actively managed. There's lots of people out there who would view that as a con. They would say people can't beat the market. Why would I want some advice, some mutual fund manager out there buying and selling different stocks, probably underperforming the market and charging me a fee to do so? So if that's how you view the market, it being actively managed would absolutely be a negative, right? And so it's kind of like this polarizing issue in the finance world where some people are very pro active management, some people are very against active management. I'm pretty agnostic when it comes to that. I don't necessarily have a strong dog in that fight. But if you're very pro active management, actively managed mutual funds would be a positive.
Sure.
If you're very anti active management, then this could easily be a con for you as well, right? Another con would be costs. So I told you the average cost for this is 0.5%, so half of a percent to 1%, somewhere in that neighborhood. And, you could, in theory, go buy all these different stocks and bonds yourself and save a lot of those fees.
Sure.
Or buy an alternative investment. Again, maybe an ETF that we'll talk about in the future. Maybe get lower fees through that. So costs could be a negative. Certainly it's a consideration you need to consider and see if kind of the value that you think you're getting from this mutual fund outweighs those costs. Another con would be there's no what we call intraday trading. So let's go back to the very beginning of our example where you, me, and 8 friends got together and pooled our money, right? So let's say me, you, and 8 friends got together, we pool our money, and we have some friend, Joe, and Joe wants to pull his money out. So he says, okay, I want to pull our money out. Well, we're like, well, all our money is mixed together. Like, how are we going to do this? So it's like, okay, at the end of each day, let's take kind of a poll. Who wants to get their money out? Who wants to add more money, right? And at the end of the day, we'll start to figure out like, okay, looks like, okay, just one person's pulling their money out. So it's just Joe. So what we need to do is sell some stocks and bonds to free up cash to give to Joe, right? So by selling stocks, there's going to be tax implications for doing that. So by selling those stocks, so first of all, I guess let's go back. So this is not intraday. So there's no trade happening. Like, if Joe called at noon and he says, hey, I want my money, nothing's happening until the market closes. They kind of
So it's not during market hours specifically.
Nope. Okay. It would be after market hours. They take a pool. Who all wants in? Who wants to put more money in? Who wants to take more money out? And then it kind of all gets settled. And then the mutual fund manager can figure out, okay, I either need to raise capital, so I need to sell stuff, or we got the cash coming in, so I need to buy stuff, right? And that's how they figure out, that's when they would figure out exactly what the value that they would be able to provide to you and stuff. So you don't actually, when you go sell some of your mutual fund, you don't exactly know down to the penny exactly what price you're going to get. Or if you're buying a mutual fund, you don't know down to the penny exactly what cost it's going to cost you to buy until the end of the day. And the kind of mutual fund manager can pool everything and figure out, okay, who all wants in, who all wants out. Let's see, okay, what are we going to charge them to get in? What are we, so you don't know exactly what the cost is getting in or getting out. So no intraday trading, that could be a con. And then I started to allude to this. So again, let's say our friend Joe wants out. So we, nobody else is adding more money. So he says, I want my money out. So the mutual fund manager would say, okay, we have to raise money. We have to sell stocks and bonds to get Joe his money to give to him. And so he sells all these stocks and bonds. And he says, okay, we sold all these stocks and bonds. Maybe he had bought some stock that had gone up a lot, right? And now the mutual fund manager had to sell some of that. And again, remember, all of us are sharing in the tax implications. So you and I maybe didn't do anything with our investments, but we're getting tax implications because of what Joe did, right?
Gotcha.
And so that can get tricky. Like if maybe me and you, we talked earlier on a future podcast about maybe doing things like Roth conversions and how those align pretty closely with where you're at in your tax brackets. So if you and I were thinking through this and maybe making decisions in our financial situation that affects that, these are based on like certain tax brackets or there's different tax brackets and stuff, but if we're making, at the end of the day, if we're making financial decisions and we don't know, we're not going to have all the information. There's these capital gains distributions that get sent out. Oftentimes you're getting provided this information like in December. So you may have made decisions earlier in the year, then come December, they're like, hey, you actually have these other tax implications. And you're like, God, I didn't even know how to plan for those tax implications because it could have been anything.
Sure.
So sometimes there'll be these crazy scenarios where the market's down so that your investments have lost money, but you're being taxed as if you had made money.
Yeah.
Right? That one always throws people for a loop. But that scenario can happen. But the inverse can happen as well, where your investments are up, but your mutual funds are kicking off like a loss, right? Because again, it's not necessarily directly tied to just you. There's these other people in the pool that are now affecting. So as you're sharing all that, it's nice to share the costs with them and stuff, but you also have to realize their decisions are affecting you in other ways as well.
Sure. No, that's really, really well painted for that. Because, it obviously is going to depend on the situation, the person, and what your interests are and what your goals are with everything too. So, but this definitely gives a high level breakdown of kind of what a mutual fund is. So I hope everybody learns something here, because then you can be like, hey, I kind of know what you're talking about. Like obviously there's more layers to it, and once you figure like it's just with anything, it's like, cool, I feel like I got a good handle on it. Then something changes, and you're like, well, don't know that one. But
no, I promise you, if you can get just that level of understanding around mutual funds, you'll know more than anybody else at that party probably.
Yeah, nice, cool. I can't wait to be like, hey, cool, who wants to talk mutual funds? Let's gather around. But awesome, Ryan. Well, I appreciate it, man. We'll pause here and we'll do a little bit of a personal thing on the other side, and then wrap this bad boy up.
And now, to put the personal in personal finance.
Welcome back to the Fiscal Physical Podcast. We are in our personal section here, and this one is just something I've always been curious about with you, Ryan, and I'm curious about with everybody too, because everyone has a different upbringing, childhood, thoughts, heroes, goals. Was there somebody in your life who was, or something, I guess, that was like your biggest influence or inspiration, like growing up?
Yeah, I don't know. That's a tough one for me. Nobody that like immediately comes to mind. Like I didn't base my life off of some, anybody.
Sure.
So yeah, not a great answer. I mean, I'll apply this financial lens to it, I guess. And the person that I resonate a lot with from an investment philosophy standpoint is Warren Buffett.
Nice.
And so if you go pull all the people I quoted in my book, I don't know for a fact, but I'm gonna go out on a limb and say Buffett was probably quoted the most in the book. He's also a quote machine. He puts out great quotes, so that makes it easy. But certainly, I wouldn't say he really influenced or inspired me a ton growing up. But again, to apply this finance lens to it, at least I'd say Buffett certainly influenced me to some degree. I'd say, Aaron Rodgers, he
Sure.
influenced my Green Bay Packers fandom. So I'll just give a shout out to Aaron Rodgers and
I'm sure he's listening.
Brett Favre and Bart Starr for all getting Super Bowls.
Yeah.
I don't know that I have a great answer to that. What about you?
Yeah, it's interesting that you bring that up because I was researching some stuff for the podcast, and I found out that do you know what Warren Buffett's nickname is? What they call him?
The Oracle of Omaha?
Yeah. What an awesome name. That was so cool. I was like, that's so neat. But for myself, growing up, I was big into sports growing up, and I really idolized Ken Griffey Jr.
Oh, yeah,
he was a baseball player for the Seattle Mariners. I dressed up as him for Halloween for 6 straight years.
Oh, wow.
Yeah. So I was really obsessed with him.
That's awesome.
And I remember going to, I just was always I just want to be this guy. I want to be this guy. I didn't bat left-handed. I wasn't African-American. There was no similarities between him and I whatsoever. But I was like, that guy's awesome. I want to play for the Mariners. And then I got to be 12, and I was like, I'm not good enough at any sport to go pro. So, but I always had all his books and read all his stuff, and he was just kind of had an inspirational story just overall. But then as I kind of got older, I looked at what my parents did and how they were able to raise 4 kids and not a very big income and kind of just provide us an awesome childhood.
Right.
And so I automatically kind of put them up on a pedestal as well. But I'm kind of with you. There's no one specific person that I've shaped my life around, but it's been a combination of people that I've been hey, I really like how you did this. I'm going to implement that in the way that works for my life.
Yeah, I think certainly I've seen that too. If you kind of idolize any one person, there's always something about that person that could probably be better. They're human, right? And so, I think kind of taking bits of pieces from different people is a recipe for success.
Yep, I think so. Diversifying, if you will.
Oh, I like it. Nice. Yeah, very good. Very good.
Excellent. Well, we'll go ahead and wrap this one up here. Really appreciate everyone who's been listening. Definitely check us out on the different podcast platforms. If you guys have feedback, email us, podcast@alchemywealth.com, or just send us a text. I know that we have, several people have reached out via text just to ask questions about this podcast, so I'm pretty excited about that overall. But anything else you want to leave us with here, Ryan?
Yeah, agreed. Thank you, everybody who's following along. We're enjoying this journey, so hopefully you are as well. And as always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.